Hello traders, you are welcome back to the Forex Geek channel. And in this particular video, we are going to be looking at one of the most popular trading methods in the crypto world, and that is the crypto day trading. Okay, if you've ever wanted to learn how to make profits from short-term price movements, this strategy is for you. In this video, we're just going to be breaking down the essentials of a successful crypto day trading strategy and show you how to spot opportunities for quick trades. All right, let's just jump in, right? Let's jump right in. Okay, what is crypto day trading to start with? Simply put, day trading in the crypto market involves buying and selling digital currencies within a 24-hour period. Simple. All right, that's exactly what it means. Simply put, it is a strategy that involves trading within 24-hour period. So the goal is to capitalize on small price movements by entering and exiting the market quickly. Unlike long-term investing, day traders are focused on short-term gains, which means they often make multiple trades throughout the day. The crypto market is perfect for day trading because of its volatility. Cryptocurrencies can experience big price swings in a matter of hours, creating opportunities for traders to profit. However, this volatility also brings risk, so it's important to have a solid strategy in place. Now that we know what crypto day trading is, let's just quickly talk about the best time frames for making successful trades. When it comes to day trading crypto, selecting the right time frames is crucial. The popular time frames for day trading are typically the 1-minute chart, the 5-minute chart, and the 15-minute chart. Also, the 30-minute chart goes. This chart allows you to see price action in real time and identify quick opportunities. Let's quickly talk about the 1-minute chart. The 1-minute chart is actually great for traders who want to capitalize on very short price movements. However, they can be quite volatile, so they require quick decision making. Then as for the 5-minute chart, these charts are ideal for spotting trends and entry points without being overwhelmed by the noise of the 1-minute chart. Then for the 15-minute and the 30-minute charts, these offer a broader view and can help you spot mid-term trends, allowing for slightly longer trades. So it's important to understand that each trader has their own preferred time frame, and it often depends on their trading style and comfort level. But no matter what time frame you choose, it is key to focus on the shorter time frames to catch those quick price moves. All right, now let's quickly talk about the key indicators that every day trader should use. These indicators will help you identify potential entry and exit points in the market. First of all, moving averages are one of the popular indicators that a lot of traders use. Okay, we have the 50 period and the 200 period moving averages. They're the most commonly used. All right, the 50 period EMA and the 200 period EMA. All right, 50 period EMA and the 200 period EMA. Okay, so when the price crosses above or below these EMAs, it can indicate the start of a new trend. Basically, when price crosses above the 50 and 200 period EMAs, it shows an upward momentum. Can you see? There was actually an upward move happening around here. So if you had entered a buy around here, perhaps you could have set your stop loss below the previous swing low, and then you just target, resistance zones. You can go back. If you go back, you look out for resistance zone. This was a support that turned into a resistance. So this would have been one of the places to exit. But if you do not have a good risk to reward ratio, then you can just stay out of the trade. For example, in this case, the risk to reward was 1:1. So this was not a good one. We actually had another resistance around here. So if the momentum was strong, this would have been another profit taking target. Right? There would have been another target to exit. You can see that price actually got there. Okay, now the next indicator we're going to be looking at is the RSI, the Relative Strength Index. Right, this is an important momentum indicator that helps you spot overbought and oversold conditions. Basically, an RSI above 70 may indicate that an asset is overbought, while an RSI below 30 can indicate that it is oversold. Okay, now the next indicator we're going to be looking at is the MACD, the Moving Average Convergence Divergence. The MACD is actually used to identify potential trend reversals. A crossover between the MACD line and the signal line is a strong indication that the trend is about to change direction. Like you can see this example when this breakout occurred to the downside. You can see that the MACD line crossed below the signal line around here. If you look closely, we had that bearish crossover. So that also validated this bearish move. All right. And then finally, we have to also pay attention to volume. Volume is very important when it comes to trading. Volume is very, very important when it comes to trading. All right. Volume is one of the most important indicators for day traders. Higher volume confirms that there is strong market participation, which increases the likelihood of a successful breakout. And if you look closely, you will see that at some points we had spikes in volumes, even though that it was not at every point in time, right? But just pay attention to volume spikes, because it can also add to your confirmation. So these indicators, when used together, can give you a clear picture of where the market is headed and help you make more informed decisions. Now, let's quickly talk about risk management. The volatility in the crypto market means that prices can change quickly. So it's crucial to protect your capital. Here are a few key risk management tips. First of all, make sure that you set stop losses. All right. Always use stop loss orders to limit your losses. For example, if you're entering a trade, set your stop loss just below the previous swing low. All right. It might not necessarily always be a very tight stop loss. That's for a buy, right? If it's a buy trade, for example, say I'm entering a buy around here, set stop loss below the previous swing low. Take profits can be around resistance zones. If it is a sell trade, when you enter a sell, once you have confirmed that sell, make sure you get confirmation. It's very important. Set your stop loss above the previous swing high. You can take your profits around support zones. It's very important. Always trade with a plan. Before entering a trade, have a clear plan in place. Know where you will enter, where you will exit, and how much you're willing to risk. So this helps you stay disciplined and avoid emotional decisions. Also, do not over leverage, because leverage can amplify both gains and losses. So it's important to use it cautiously. Stick to conservative leverage to avoid putting too much of your capital at risk. Now, day trading requires a strong mindset. The psychology of day trading is critical because emotions like fear and greed can lead to bad decisions. So stay patient, follow your strategy, and avoid chasing the market. Consistency is key in day trading, and keeping a clear mind will help you make a better decision. And that is a wrap on today's guide to the crypto day trading strategy. By using the right indicators, setting up proper risk management, and keeping your mind focused, you can improve your chances of making profitable trades in the fast-paced crypto market. If you found this video helpful, be sure to like and subscribe to the channel for more tips and strategies. Leave a comment below if you have any questions or if you'd like to see more videos on crypto day trading. Thank you for watching and happy trading.